three quick things to highlight in terms of factor selection. What we're effectively trying to do is understand what the highest expected Sharpe ratios for each, for each asset class, for each sub asset class within the asset classes for each regime. Step two is having a top down risk management overlay that incorporates these weather model signals at the asset class to accordion the target exposures per position. And then lastly, the bottom up risk management overlay. We use our volatility adjusted momentum signal at the ETF level to accordion the actual exposure as a percentage of the overall target exposure. And so again, how we get to the factor selection process is through the lens of our grid asset market back test. We do the vis-a-vis annualized expected returns, present positive ratio, volatility, covariance. We use all this information to conduct expected Sharpe ratios. We summarize that here. We're in a deflation regime, so our portfolio is allocated towards deflation. One thing I will call out is that step three, very important step in terms of like kind of managing broader macro market cycle risk. So right now we're in a high conviction deflation regime. The deflation regime, that's high conviction. And so what that ultimately means is growth is trending lower, inflation is trending lower. That two arrows down equals deflation in terms of our grid model framework. The consensus estimates, because economist consensus estimates are expecting growth to continue trending lower. They're expecting inflation to continue trending lower. So all four of those moves or four of those signals are contributing to a high conviction deflation regime. We're in deflation. Everyone expects us to remain in deflation for at least a year. So that's where you're getting the high conviction. If we start to see, let's say we roll the clock forward 1, 2, 3 quarters, and we start to see up arrows in these the next 12-month real GDP delta, up arrows in the next 12-month real GDP delta, you might start to see something that looks like Goldilocks or reflation from a grid regime perspective in terms of the conviction score. And so once that starts to happen, the portfolio will start to allocate, exposures to, either reflation or Goldilocks, even though we'll still be in deflation. This is how the weather model and the KISS portfolio construction process times the bottom of the market. We use the wisdom of the crowds. We use the actual weather model signal itself, which is born out of the 10 principal components of macro, our quantitative analysis in terms of scoring them from a signal based perspective. And so we're using a combination of our quantitative inputs and the wisdom of the crowds to tell us the market is at the bottom or the market's at the top. And that's exactly how the process is going to work. Let's call it 1, 2, 3 quarters from now, when I think we'll be at or near the lows in risk assets. So again, don't have a crystal ball, but we do have a very sophisticated portfolio construction process